Okay guys, and welcome to today's video. So this is the fifth series of fair value gap for entry. So in this series I'm going to be wrapping up the fair value gap for entries. I actually appreciate you for staying through to the end of this series, for watching through to this end. There are a lot of concepts and ideas I can share with you about the fair value gap for entries, but I just don't want to bore you with a lot of information, because the purpose of this channel is to be able to make smart money style of trading very simple, so that you can go into the marketplace and start making money for yourself. You get what I'm trying to start seeing these things pan out in price and start utilizing them in your own trading. So I don't want to bore you with many other concepts as surrounding the fair value gaps, the various variations. So I've given you 4 variations throughout this series. You can see in the first series, second series, third series, and the fourth series, I have given you 4 solid variations that happen frequently in price. So in today's series, I'm going to be wrapping it up practically on a practical theme on the basic thing you just need to have in your mind while trading the fair value gap in general, regardless of the variation that is going to happen. You know what I'm saying? So the first thing you want to consider why trading the fair value gap is, number one, is that you want to first be able to identify the fair value gap in price, whether it is within an imbalance or whether it is standing alone. You know what I'm saying? So you want to be able to identify it and see it clearly. So you want to map that out. You get what I'm trying to say? So depending on the kind particular time frame, that brings about the second thing you want to watch out for. The next thing you want to watch out for is reaction of price. You want to wait for the reaction of price at that fair value gap. So this will determine the kind of variation that is. You know what I'm saying? This will determine the kind of variation that you're actually expecting, you know what I'm saying, in the marketplace. So you want to watch out for the reaction of price. And how do you identify the reaction of price in a fair value gap area? You are going to drop down to the lower time frames most of the times. Why? Because for you to be able to see the reactions quickly, you know what I'm saying, you want to go down to the much lower time frame. So you want to watch the reaction of price. That's the second point you want to remember why trading the fair value gap. You want to watch out for the reaction of price. Even with any institutional reference point, you want to watch out for the reactions of price at that particular area of liquidity or area of imbalance. So as the case may be, now we're talking about the fair value gap. So number one thing is that you want to clearly identify it in the time in the time frame charts that you're trading, and I recommend the monthly, the weekly, and the daily. And secondly, you want to watch out for reaction of price at that particular area or that particular level. Number 3 thing is that you want to consider the institutional order flow. You want to say, are we currently in a bearish market condition or are we in a bullish market condition? So if we're having a bearish fair value gap that has just been created, is the institutional order flow suggesting bearish? So if, look, let me go over that again. Let's say we're experiencing a bearish condition in the marketplace, and what we have is actually a bullish fair value gap. So you want to actually ignore that particular fair value gap or watch out for the reaction in price. There's a lot of probability that that particular reaction in price is not going to be very significant. I'm talking about in that area of fair value gap is not going to be very significant. So that's the third thing rather you want to be watching out for. You want to be understanding the institutional order flow. You want to say, and I've done a work on institutional order flow, and I'm going to be coming up with more series on that later on. But you can check the recent video I uploaded about institutional order flow, and you can learn how I go about institutional order flow. So you want to understand that particular action in price, and that will help you better time your entries using the fair value gaps. So without further ado, there are other couple of things, but I think with these 3 things. Okay, and one more thing, let me just add this here as a bonus tip. You want to also consider the market condition. Are we in a consolidating market condition or are we in a trending market condition? So you want to map out that also in time. So when you're able to identify these things in price, then you can be able to go in and be able to get that reaction in price you want to see at the area of your fair value gap. You get what I'm trying to say? So let me just go over some few examples. Going over the process one step at a time. So with our first example, we have mapped out here in price. So we have identified our fair value gap right here. So let's just say we're anticipating this using the benefit of hindsight, dropping into this particular area. So all we have to do is drop to the much more lower time frame and get to that area right there. So we can see the impulse of price downward. So you can see at the last candle here, you can see the reaction. The reaction was actually bullish. Was actually like a hammer pattern. This is an hammer pattern right here. You can see the reaction in price. There's a weak rejection even at this area, and to the lowest point of this particular swing low right here, you can see there's also a fair value gap that price actually reacted to quickly. So the reaction in price at this particular area is actually very significant and is worth taking. Then the other element you want to consider is, okay, institutional order flow, what is it suggested to us? So you can see that this low at the point of creation, when this candle printed, didn't take out this low. So this particular area is quite valid for an entry. Okay, so you can enter here and exit right here using this daily time frame fair value gap. So the next thing I talked about you want to consider is the market condition. So you can see that we just left this particular range with this expansion higher. Price is retracing, so this retracement could actually send price higher, saying that it didn't violate this particular low. So that is how I will anticipate the fair value gap and trade it. So the next example I have on my chart is the one you have right here. So let me remove this particular markup so you don't get confused. So right here we have this one right here. So this is the fair value gap right here. So I'm going to be going over here because in the fourth variation we discussed in the fourth series, I talked about this candle coming in, then later on this particular candle coming in. So we're going to look at the two candles. So let's just say we are anticipating this drop in price and we're on the 4-hour right here. We can see how price came down into that particular fair value gap. The reaction in price was quite significant. We got a swing low right here and there's a swing low right here, but there are areas of imbalance down at this point that price didn't fill in completely. We can see it clearly. The price didn't come down for this imbalance because this is where the recent swing low as regard relatively to this particular swing low was. So if we use our Fibonacci, we can see that based on the range, you're trying to say based on the range, price has not really dipped in completely as we want it to get to as our sweet spot entry. So for those of you that understand the Fibonacci strategy, the way I teach it, that is another key thing you also want to note, but that is not significant, too relevant for you to bother yourself with in this series. Just think about the first things I say. Number one, you want to identify your fair value gap correctly. Number two is that you want to watch out for reaction of price in that level and you go down to a much more lower time frame. Number three thing, you want to consider institutional order flow. And number four thing, you want to understand the market condition. So let's just go over with these four things I just mentioned. I like keeping things very, very simple. So you can watch out. You can see right here in price that so far so good. Price have actually been trending. And so we're in a trending market condition. So and at where we are now, this is what I call a no man's land right here. You get, so at a no man's land like this, you want to be very careful, especially when trading at the very peak, when you're having a curve. You want to say, so you want to watch out for reaction on price. You don't want to be holding trades for too long. So what you want to do is that you want to hold your trade for just a while to see if it can get above this high. And price relatively expanded a little, but not too significant. And later on, we saw this dip in price. But even at the dip in price, we can see the reaction right there. And that is a sweet point of entry. And it actually gave us a good amount of return. And that is about 1,009 pip, 1,900 pip on this particular second dip into the imbalance. So when you see the move, a move like this, reaction in price, you don't want to be holding your trades for too long. You know what I'm saying? Especially when you're at a peak like this, a peak in a trending market condition, you don't want to be trading at this range right here. Why? Because if you look at the main range of this particular impulse move on the daily time frame, that area is not actually very, very significant. It's not actually near the equilibrium. So you want to come use your Fibonacci. So the equilibrium is right here at the 50%, and the near-term equilibrium is at this 61.8 level, and that's where you see this particular price dipping into. So you want to consider these things too also in price, the price range. That's why I say you must understand the market condition they are trading within. So you see price came in. Mind you, it didn't come in for Fibonacci. Don't think that you always find that out with Fibonacci. It actually came for the imbalance, but you can use the Fibonacci to time and understand why price actually is coming back the second time, and that's what you see happen in this particular area of price action. So I'll give you one more example and I'll call it a day in this video. You can see right here on this particular area I marked out again. So you can see 1, 2, 3, and price is about coming in here on this particular place. So what we want to do, we want to drop down to the lower time frame, which is the 4 hours, and see the reaction in price. So we can see right here the reaction in price. We have more like a consolidating. Mind, these are 4 hours candle. Also, there's this move higher. So this move higher tells us, okay, there are institutional sponsorship in this particular level. You can see that we want to see price go higher. So the next thing we want to understand is institutional order flow. So we'll go back to our daily time frame to understand that, and we can see so far so good. At this point of fair value gap right here, there's an obvious swing right here, an obvious swing right here, and price has retraced right here. You know what I'm saying? So if price breaks through this consolidation that is forming on the 4 hours around our fair value gap area, then that will consider a buy option for us. And we can see price expanded, breaking this swing high right here for us, just around the fair value gap area, and price retrace. So this will be our entry right here. You get with greater degree of confirmation, and price expanded higher, giving us 1,700 pips. So this is how you want to go about the fair value gap. You just don't want to go, you want to blend some couple of concepts. You want to say some of them I've taught here on this channel, especially like institutional order flow. I'm going to be coming up with other contents that will help you better time your entries in the Forex financial market. Thank you very much for staying true to this series. If you find value in this content, hit the like button, hit the subscribe button, and see you in our next videos.